Hello and welcome to Practice Problems for Chapter 2. We're going to be working with numerical examples, particularly a shorting stock example and an options example in this video. But I just want to give you a quick reminder that in this class, we're not going to just have numerical problems, we're also going to have conceptual problems. And the place to go for understanding conceptual problems, as shown here in each of the practice problems pages, is to review the video lectures, the corresponding handouts, and then also take a look at the concepts, definitions, formulas handout. And you can also look at the two textbooks and, of course, speak to the TAs and myself on the discussion forums and during our office hours. Okay, so without any further ado, let's jump right into a stock shorting example. So let's say that Tesla is trading today, or maybe better said at this nanosecond, at $1,000 a share, and you have a view that the price is going to drop to about 600 a month. You just don't see how it's possible to scale up to their next year's proposed number of vehicles sold with the factories they have in hand and the factories they can build over the next 9 to 12 months. So for that reason, you think that everyone else in the market is going to wake up to that in the next month and the price will drop to about 600. Of course, you could be wrong, but that's your view. So what do you do to take advantage of that? You tell your broker to sell short a share of Tesla for 1,000, and that will start your trade. And what actually happens then is the broker is going to borrow a share from someone else's account called the share lender's account, and she's going to go out and sell that borrowed share on your behalf for $1,000, which is what Tesla is trading at right now. And she's going to put that $1,000 of cash into your account, but it's going to be restricted. It's going to be in what she calls your short restricted account, meaning you just can't take out that $1,000 right now. So we want to know here what's the gain or loss on this trade if Tesla's price goes down to 500 a month. So that would be better than your estimate. Or B, if the price goes up to $2,000 per share in a month. So the way to solve all of these problems for shorting stocks as well as for options is to set up a time event cash flow table. Okay, I'm going to include case here so we can solve A and B in the same table. But in general, you want to have what time is it? What's the event that happens at that time, and what's the cash flow to or from you? Don't worry about any other cash flows. And then maybe we'll take some notes as we go along. So we're starting now, okay, today, all right? And the event is that we're going to borrow and sell one share of TSLA. All right, so when that happens, broker borrows that share, sells it on your behalf for 1,000. So you actually get 1,000 into your account. And I'll just note here that that's restricted. You can't withdraw that money right now. Okay, and then let's go to a month from now. And in case A, Tesla's price has decreased down by 50%, down to 500 a share. Yahoo, right? That's great news. So what we're going to do is we're going to instruct the broker to buy one share at 500, right? And then return that borrowed share into the share lender's account. Okay, so she goes out. Where does she get the money to buy that share for 500? Well, you've got 1,000 there in your restricted account, so that's where the money will come from. But the key thing is we have a minus cash flow from you, because one way or another she's taken your money to buy that share for the market price of 500. Okay, and now we're ready to look at here, we're done. So we're ready to look at the net cash flows to you, and that is what we call the gain or loss, right? So that's going to be just the 1,000 that we got when we initially shorted the share, and the minus the 500 that was required to go out and buy another share and return it to the share lender's account. So now you've got 500 in your account, and this is not restricted. So once you close that trade, you can go ahead and withdraw that $500 and do whatever you want with it. Awesome. All right. So now let's go to case B, and we're just going to do exactly the same thing. Okay. So what we do now is exactly the same as it was before. Okay, so we're just going to borrow a share from someone else at, say, Interactive Brokers. That's my brokerage, for example. Somebody else's account at Interactive Brokers gets a share of Tesla borrowed from their account, and our broker sells it on our behalf, et cetera, et cetera, et cetera. Okay, and in 1 month, okay, we're going to have to do the same thing. The broker is going to have to go into the marketplace and buy a share and then return that share to the share lender's account. Okay, but now here's the bad news. The market price of Tesla, we were so wrong, you were so wrong. Or maybe you were right, but your timing was wrong. Maybe Tesla is going to drop by 50%, but it's just going to take more than months to do that. But too bad for you, too bad for us, to close this trade at the end of a month. And remember, with all of these, the way you want to think about it is we always want to end up in cash, not with any shares of anything. Okay, so at the end of this trade, the net cash flows are going to look just like this. Oops. So you have lost a cool $1,000 on that trade. And just quick note, the parentheses here are the exact same thing as a minus sign. Putting numbers like this is just what accountants do to designate a negative number. Okay, so you had a cash inflow here of 1,000, a cash outflow of 2,000. Where did that 2,000 come from? Well, 1,000 of it came from this restricted account, and the other 1,000, the broker was either sitting around in cash in your account, or the broker required you to immediately wire in another $1,000 so she could go out and buy that share for you. Okay, so that's how it works with shorting stocks. And as you can see here, if the price went up to, say, $6,000, you would have lost $5,000. You would have had to potentially wire $4,000 into your account. So shorting stocks, you can make a lot of money if you're right, but you can lose an infinite amount if you are wrong and the stock continues to appreciate when you're hoping it will go down. So, okay, that's enough for this. Let's move on to looking at an options problem. So let's see what we can do here. We've got an option example. So Moderna's stock is trading at $200 a share today. You expect its price to increase a lot, but of course you're not sure. So you buy a call option today, which is going to give you the right to purchase a share in 1 year for 210, and that contract, that option contract, the call option contract, costs you $10 to purchase today. So what's going to be your gain or loss if Moderna is trading at 300 in a year? And as always, we're going to assume that we want to end up with only cash. In all of these problems, we always assume we want to end up in cash, not shares of stock. So the way to solve this is to set up a table. This is going to be true with all of these. It has time, what's happening, and what's your cash flow at that time. So let's start with now, and we've already said we're going to buy the option. So we're going to buy the option, and the cash flow for that cost us $10. That's right. Okay. So now nothing happens for a year. We go into suspended animation, and at the end of the year, we emerge from suspended animation, and we find that Moderna stock is trading at 300 in a year. So what are we going to do? We're going to shake loose the cobwebs, and then we're going to say in 1 year that we want to exercise the option, right? Because we have the right, but not the obligation to purchase the share. So we're going to exercise the right and buy the share right? Buy one share, okay? And that gives us, we have to pay, the contract said we have to pay 210 for that. So that's going to be another negative cash flow, right? So we put 10 out to get the contract, another 210 out to buy the share. So things are not looking so good for us, except don't forget, right, that the stock is trading in the marketplace at 300. So let's go out and we want to wind up in cash. So let's sell the share. And now we have a positive cash flow of 300. So our net cash flow, which is equal to our gain in this case, or it would be loss if it were negative, is $80. So that's pretty good. So we did pretty well on that, but maybe there's trouble. Maybe we could have done better. Let's think about this same problem above. What would the gain or loss be if you simply purchased a share today and sold it in a year? So we'd have now and we'd have 1 year, okay? And what's going to happen here is we'd buy the share. It's trading today at $200, so we have a $200 cash outflow, and we want to wind up in cash. So in a year, we're going to sell the share for 300, and we would have a gain of $100 compared to only 80 if we bought the option. So maybe it looks sort of stupid to buy the option, but no, I don't think so. Moderna is a very, very volatile biotech stock, so bad things could happen. Like, for example, Moderna could be trading at 100 in a year, okay? And we decide to buy the option. What's going to happen? So now we buy the option and we'd be out 10, and in 1 year, okay, we're going to choose to do nothing. And what they would say in business schools is choose not to exercise. I don't mean business schools, I mean graduate business schools, of course, MBA programs. Okay, so we are choosing to do nothing. So what's our cash flow if we do nothing? Nothing, zero. Okay, so we're out 10 and the stock crashed from 200 to 100. So maybe it's pretty good protection. To think about this a little more clearly, let's say we've got the same problem above, and we just decide to buy a share instead of buying the option, and then Moderna crashes in a year. What's going to happen? So now we buy the share, okay, and our cash flow is minus 200, okay, and then in 1 year, we want to get back in cash. We want no share, so we have no choice here but to sell the share, okay, and we get 100. So that's really nice, except we invested 200 and we only got 100 back. So our gain equals our loss in this case is 100. And if we had bought the option and Moderna flamed out going from 200 to 100, we only would have lost $10. Here we lose 10 times as much. So that really describes for you the good, the bad, and the ugly of options. You always are paying for these options, so they're always going to take a little bit off of your upside, right? Because you got to pay for the contract. So we got 80 here instead of 100, but they really, really, really save you on the downside. If things are going really badly, all we're ever out is what we paid for the option, because in this case we just choose not to exercise it. And if we had just done the traditional simple thing of buying a share and then selling the share, we would have lost 10 times as much. Okay, so I hope that helps you, and that's all for now.